As we told you earlier, the worst-kept secret in the financial industry is out tonight. As expected, the Bank of Canada raising its benchmark interest rate by a quarter point to 0.75%. That is the first increase in nearly 7 years, follows a slew of positive economic reports. It's going to lead to an increase in the costs of home equity lines of credit and especially your variable rate mortgage. Joining us tonight to offer some insight, Clinton Wilkins, a senior mortgage advisor in Halifax. I want to thank you so much for coming in today.
Thank you.
This was not unexpected.
No.
And in the headline on your blog today said, quote, "The chickens have come home to roost."
It's true.
What do you mean by that?
We've been saying for 7 years that the rates are going to go up. They've been at all-time lows. And the speculation from economists every year, every quarter has been, okay, the Bank of Canada is now ready to increase. And there's been a variety of reasons where they haven't increased it. But the Bank of Canada today has decided to increase their key lending rate by 0.25.
And you point out the five big banks kind of started jacking up their rates even prior to today's official announcement, yet they generally kind of drag their feet when it comes to cutting rates when that central bank rate goes down.
It's 100% true. In the past, the overnight rate has gone down, and the big five have not passed along the savings to consumers. But I'm going to bet this time around we're going to see a full pass along of the increase. I would assume that the bank primes are going to increase by 0.25. We don't know yet. It hasn't been announced, but I suspect between now and overnight, by tomorrow morning, we're going to know exactly where the big five are going to sit.
They all generally, there isn't a whole lot of competition there, is there? They don't really try to outdo each other. They all tend to keep the rates the same, am I wrong?
Typically, they're usually in line. Right now, they're a little bit split. RBC and TD, their rate is a little bit higher on their bank prime for mortgage lending, where the other three, it's a little bit lower. So it'll be interesting to see what actually happens once they put out their announcements later on today.
Ultimately, and we know the Bank of Canada governor releases a whole bunch of reasons about why this decision was made, but a lot of folks might just think, well, really, this just leads to bigger profits for the banks.
You know, at the end of the day, it's going to increase the cost of borrowing for the banks. When the Bank of Canada increases their key rate, that's going to pass along a more expensive, funds for the bank, which at the end of the day, they need to pass along those at some point to the consumer.
And you point out that the prime rate increase really won't have much of an impact on new home buyers because that's tied to the qualifying rate.
That's right.
Yeah.
So last year, the federal government changed the way that mortgages are qualified in Canada. Anytime it's an insured mortgage, so anytime that a mortgage is insured by the Canadian Mortgage and Housing Corporation, Genworth, or Canada Guarantee, the mortgage has to be qualified with the posted rate. And that posted rate is a fixed rate, a 5-year fix. Currently, the posted rate is 4.64. Also, any variable rate mortgages or home equity lines of credit, if they are conventional, need to be qualified with the posted rate.
But
so
those variable rate, this is what we're talking about, they will increase.
They will increase. So consumers are going to see a higher mortgage payment, or they're going to see a longer amortization when the banks decide what they're going to do with their prime rate.
Do we have any sort of average maritime numbers on how much this will cost, say, the average maritime homeowner, mortgage holder?
Well, it depends on their amortization, but let's say the average consumer has a mortgage payment of $1,000 a month, let's say for a round number. I would assume after the increase, their mortgage payment would go up about $50 per month.
$50 a month, yeah, which adds up to a few hundred over the course of the year. And no impact on fixed rate mortgages.
That's right. Fixed rate mortgages move completely independently of the variable rate. The variable rate's tied to the Bank of Canada key lending rate, which then is transitioned to the each bank's prime rate.
Right.
So the prime rate less variable. So for example, maybe someone has prime minus 75, for example. When the prime rate is set, then their rate will be then whatever it is based on that.
Would you expect this is the beginning? And I'm asking you to look in your crystal ball.
Yeah.
Is this the beginning of a bunch of increases now that we're going to see, or is the BOC just kind of testing the water here right now, do you think?
Well, they were the first of the G7 to increase rates. So that being said, we don't know what's going to happen. I'm not an economist. Right now, they've been at all-time lows. So eventually, the rates need to go up.
Would you, variable rate customers then who are going to see those increases, should they be dashing to the bank now to insist on a fixed mortgage, insist on locking in?
Historically, clients do better in a variable rate product, better than they do in a fixed rate product. In my opinion, I don't think anyone should make a change. I think they should stay where they're at. 0.25 of an increase is a very, very small increase. Even with the increase, clients are doing better in a variable rate product than they are in the fixed rate product. And for example, when a fixed rate product comes up for renewal, they have to renew at whatever the rates are in the day.
Right.
So just imagine if the rates do go up, the fixed rates go up, and you're in a fixed rate product, you could have much larger payment shock based on an increase of a fixed rate. Whereas if you were in a variable, you could see small increases over time. So it can almost accustom you to the increase that's going to happen.
One of the concerns about this is people have said for years that, well, this is a real wake-up call for folks who are carrying too much debt. Do you see it that way?
I would agree with that.
Yeah.
I think that people need to look in the mirror, and I think they need to seek the advice of an unbiased mortgage professional, specifically around their mortgage lending. It's the biggest piece of debt in people's lives, and it's also the biggest purchase of people's lives when they buy a home. Now's a really great time to seek the advice of a mortgage broker or your financial advisor, and get the advice that's going to be best suited for your needs and the needs of your family. I think right now we're in a situation where I don't think people should make a change, but it's good to look in the mirror and make sure that they're in a good situation. Clients that were qualified for a mortgage after the stress test went into effect, they're going to be okay because we already know they can afford it.
Right.
It's the clients that had a mortgage from maybe years ago and prior to that stress test, maybe they were already close to the line at that point, and maybe something has changed in their situation that could really impact it.
They bought more house than they really could afford.
Yeah, maybe they bought more house, or maybe their financial situation has changed. So oftentimes it's good to seek the advice before things get to a situation where maybe they cannot afford it.
We're running out of time here. I know you suggest people who might get ahead of this by maybe making some extra payments. Tie your payments to your paycheck, that kind of thing. Just get ahead of it before the increase, really kicks in. Any other advice for folks who might be having trouble sleeping tonight because of the announcement today?
0.25 is not a big increase. In our opinion, you should stay where you're at. Also, having your payment frequency set up with your payroll is most effective, and maybe it's a good time to look at doing a payment increase. So that will shelter you from any increase in the future.
Well, thank you so much for joining us
problem.
today, Clinton.
Thank you so much.
Clinton Wilkins is a senior mortgage advisor with Centum Home Lenders Limited, joining us tonight to talk about the quarter-point increase announced by the Bank of Canada today, one that will cost millions of Canadians millions more in mortgage payments each and every year for the foreseeable future. We're interested in your thoughts on this in our CTV News web poll tonight. What's your reaction to the rise of the interest rates? Here are your options. It will affect me. I'm concerned about the impact. Might affect me, but I'm not too concerned. Or it won't affect me. I'm not concerned about the impact at all. Share your thoughts in the web poll.